Welcome back, everyone. Today, I'm going to be talking about an exciting company that has strong financials and an intrinsic value of double what it's trading for on the dip. It's a media giant that also owns theme parks around the world. Have you ever heard of blockbuster movies like Jurassic Park, Fast and Furious, and Minions? Well, they own it. How about popular TV shows like Knight Rider, The A-Team, Magnum P.I., Cheers, The Office, Parks and Rec, and House MD? They own it too, and so much more. They even have their own rapidly expanding streaming network called Peacock, which can put Netflix to shame with their library of videos. Over the past year, Peacock's revenue increased by 48%, and they gained 8 million new subscribers. They own 100% of Universal Studios, NBC, DreamWorks, and Sci-Fi. This stock is absolutely amazing. And not only that, the big index funds own a lot of their stock. Vanguard owns 10.3% of its stock. BlackRock owns 7.4%. And in addition to great financials, it pays a growing 4.35% dividend, and their payout ratio is under 22%. This is the kind of stock you can just hold on to forever. And the company is called COMCAST, a major media and telecom conglomerate. So in this video, I'll do an analysis of their solid financials with my 10 principle method of good fundamental investing, along with my discounted cash flow analysis of how the stock is worth double what it is trading at today. And by the way, Comcast did trade for double what it did today back in September 23rd, 2021. Almost $62, and you're buying a great company on the dip. The strong financials show you you're not overpaying for it. It may still go down because of some concerns over Xfinity, but this is only one segment. You have many more segments like Peacock Streaming, which is just crushing it overall. And they are doing great. So before we dive in, I want to add a disclaimer that I am not a financial advisor. I've been buying stocks for the past decade, and I'm just explaining why I'm buying this stock. Don't just buy the stock blindly because I'm buying it. After watching this video, do your own analysis before buying this stock, and let me know in the comments below what you think of this stock. Also, don't put all your money in one stock. Diversification reduces your risk in the market. Warren Buffett and Berkshire Hathaway spread their holdings across many different companies, and I spread my investments across many different companies. And I'll reveal to you other great stocks I'm buying to give you an idea of how you can diversify as well. So let's dive in with my 10 principle analysis. First, let's look at insider ownership. I like investing in companies where insiders have a lot of skin in the game. It means they will be as concerned as you are about seeing the stock price go up. The CEO has almost $750 million worth of stock at these prices, which is a lot for a company with a market cap of $112 billion. If the stock doubles, as I predict, he'll be listed as a multi-billionaire. So just think about it. Why would the CEO hold so much stock if they didn't believe the price will go up? They could just sell it and buy Berkshire Class B shares instead, or something else, if they didn't think it would go back up. And by the way, Berkshire Hathaway has 3 times their market cap in cash. They could easily buy out a company like this. And if there is a takeover bid, stockholders will be offered a large premium. I recently sold my Paramount Entertainment position earlier this year, where they offered everyone a 50% premium over the stock trading price for Class B shares. I dollar cost averaged my position down to $12 a share and sold for $16.09 a share after the takeover bid. And I regretted selling it because a month later these shares were trading for almost $20 a share. Hindsight's always 20/20. Now, the CEO having strong insider ownership leads me to principle number 2, which is analyzing the education and experience of CEO Brian L. Roberts, who earned a Bachelor of Science in Economics from the Wharton School of the University of Pennsylvania in 1981. So he has a strong business education. And as a side note, he is a member of the Zeta Psi fraternity, which is an amazing coincidence because I was also in Zeta Psi fraternity when I went to university. Roberts became president in 1990, CEO in 2002, and chairman in 2004. He stepped down as president in 2022. Now, Mike Michael Cavanaugh replaced Brian Roberts as president of Comcast in 2022. He earned a BA in history from Yale University in 1988 and a Juris Doctorate law degree from the University of Chicago in 1993. He is also licensed to practice law in New York. So at first, I didn't like this background, not because he was not in Zeta Psi fraternity, but because he doesn't have a business degree. But if we look further at his employment history, he has a lot of practical experience running large companies. In 1993, right after graduating, he joined JP Morgan Chase as an investment banker. In 2013, he became CFO of Comcast. Now, I checked if he was a CPA, but I couldn't find anything suggesting he was. And almost a decade later, he became president in 2022. So I am satisfied he can run this company well.
Let's look at the financials for Comcast. So if you look next to market cap, we see 112 billion. And next to PE ratio, we got 5.03. I love this. This is really cheap. I mean, at this price, you can't go wrong. Like, if I see a stock and it's over a PE of 25, I usually go past it, but this is like 5. Even Berkshire Hathaway is 17.03. Having a ratio of 5 is really great. And it kind of reminds me of one of these tech stocks I saw. It was called Palantir. And earlier in the day, I was looking through dating profiles on Bumble, and there was this woman who had this dating profile that I just can't get out of my head. She was like smiling in all her pictures. And then in her About Me, she wrote, "I'm a Palantir investor." And she had like an exclamation point there. And I said, wow, this girl is absolutely crazy. Palantir has like a PE ratio of 615. That is just crazy stock. And that woman is crazy. So talk about finding crazy women on the internet. This is one of them. So yeah, I mean, a lot of tech companies, they have huge PE ratios, and I would never invest in them. And I would recommend that you don't invest them in any of them either. Like, go for stuff with PE ratios of 5 or anything under 25, but 615, that's just harsh. So if you look here under analysts, it says it's a buy, and the beta score is even under 1. And like, that's anything under 1 is pretty much a safe company. So let's go over the financials. This is my 4th step. So under here, we see revenue growth. And revenue growth over the past 4 years has been going up. In 2020, you had 103 billion. 2024, 123 billion. In the trailing 12 months, it's even higher at another billion. So this is something I like to see with a company. So the next thing I would look at is like net income. How are they doing with net income? So if we see in 2020, it was 10.5 billion. 2024, 5 years later, it's 16.2 billion. And now over the trailing 12 months, it's 22.9 billion. So it's more than doubled in 5 years. And the interesting thing is that in 2021, the stock was trading at $62 a share, and their net income was 14.2 billion. And now it's at 22 billion. So this shows you, like, if you hold on to it, it's going to go up in stock price. And I really believe we're going to go back to 62. So the next thing I look at, my next step, is shares outstanding, diluted. So here we see in 2020, we had 4.6, 2024, 3.9, and over the trailing 12 months, it's 3.8. So they're buying back a lot of shares. And this is a deal breaker for me if I'm going to buy a stock. If I see dilution, I will just go right past it, because when a company buys back shares, it raises the stock price. When they dilute it, it just shows there's a whole host of problems with the company unless they're merging with another company. So you see this with high PE companies like Palantir. They're diluting their shareholders. Even Tesla's diluting their shareholders, and they have a really high PE. So the next step that I go over is the balance sheet. That's my step 6. So let's go here, which is cash flow. So I see here in 2020, you had 11.7 billion. So they probably spent it on something, but from 2022 up till the trailing 12 months, it's been rising each year. So you had 4.7 in 2022, and in the trailing 12 months, you have 9.6. And another thing you should look at when you see it went down and then up is what were the total assets? Did they go up or down? And the total assets went from 274 billion to, let's see here, 274 billion. So they didn't lose any assets overall. But how does this compare to total liabilities? So total liabilities in 2020 was 180 billion. And now it's at 176 billion. So total liabilities has been going down. What about long-term debt? Here we got, in 2020, it was 104 billion, and now it's at 95 billion. Very good company. That's very strong financials. The debt is not going up, it's going down. Total liabilities is going down while assets are remaining the same. That shows there's a lot of money here, and it's a great investment. So next thing, let's see the dividends here. Dividend history. You can see payout ratio is under 22%. And if you look at the history of dividends, so in 2021, they were paying a 23-cent dividend. Now they're paying a 33% dividend. So it's constantly going up, yet the payout ratio is still under 22%. That's strong financials. So let's go over ratios here. Now, the first ratio I look at is price to free cash flow. So we see price to free cash flow is showing up current 5.73. Now, this is under 20, and that's one of the, so at 5.73, it's doing really well. Next thing is debt to free cash flow. So what you usually want to see is like 5 or under. So this is 5.22. It's still very close to 5. And overall with everything else, I mean, this is acceptable to me. Now, the next thing I like to look at is return on invested capital. So here it says return on invested capital is 7.38%. So if return on invested capital is over 9%, it means they had got like a competitive advantage. Here, because you have lots of competition from other mobile and internet providers, the return on invested capital is going to be lower. And this means for every dollar they spend, they get like a 7.38% return. However, if you compare it back to 2020, you had a 5.42% return on invested capital. So they're doing better than they did over 5 years ago. So let's explore how I arrived at double its value using the discount cash flow method. So if you look here, free cash flow in 2024 was about 15.5 billion. Net debt minus cash is 92 billion. And the other assumptions are growth rate of free cash flow for the first 5 years of 5% a year, terminal growth rate after year 5, 2.5%, and a discounted rate of 8%. So here's the formula that we put in. So the terminal value at the end of year 5 is 368.36 billion. Now we're going to discount back to present at 8%. So here's our rough estimate. And then the present value of terminal value is 250 $321.67 billion. And the total enterprise value is $321.01 billion. Now, let's subtract net debt to get equity value, which is $229.24 billion, and divide shares outstanding to get per share value. So we put it in to this equation, and we arrive at $64.6 per share.
Now, that wraps up my breakdown of Comcast, a media giant trading at a big discount with a huge upside, and a rising dividend that makes me want to hold on to it forever. If you found value in this analysis, make sure to hit that like button and subscribe for more deep dives where I am applying my 10 principles of fundamental investing, and share this video with anyone who's looking to buy companies on the dip with strong financials. And don't forget, I want to hear from you about what you think about Comcast and their financials. Are you bullish on their streaming future and studio success and theme parks? Well, drop your thoughts in the comments below. That's it for today.